Before I get started today, on behalf of Brad and myself, I just wanted to say thank you guys so much for your support so far to S&L Capital Group. We've been in business now for 2 years, coming up in about a week, and we would not be here without you, and we fully are aware of that. And your support is really, really appreciated, and we can see the numbers on our social media platforms between LinkedIn, YouTube, Facebook, and Instagram. They've been climbing steadily, and because of that support, we wanted to continue to put out good information for you regarding hard money and private money. Today we're going to highlight a deal that we closed on a 30-year fixed rate loan that really was something that Brad and I have never heard about in the industry for the last 7 or so years that I've been in this particular industry. So we're excited to give you more details about that. With that being said, this video will be a little bit longer, but I hope you can find the information valuable. Our other videos are a little bit shorter to just kind of spark some activity in the brain. Maybe you can implement those strategies and ask those questions on your day-to-day real estate investing life. So with that being said, what do we hear about California investors? I hear it all the time. I've been hearing it for years whenever we're at networking events and investment clubs. You can't find cash flowing properties in California. The cap rates are crap. Tenants have more rights than anybody else in this world. I'm selling all my property and I'm going to Tennessee or Texas or Florida. And as I don't necessarily disagree with that sentiment, obviously I'm exaggerating on some of those points, I think as mortgage professionals, we're kind of missing the boat on a large population of borrowers or potential borrowers. Because yeah, it's very hard to find a cash flowing property to purchase today. And cap rates are historically low. And it's difficult to have deals pencil out. But what about the client or the borrower who's owned a single family residence to a 4-unit property for the last 5 or 6 or 7 years? That's exactly the case on this particular deal that we're going to go through. And it just goes to show you that, sure, it may be hard to find cash flowing properties on purchasing, but what about a refi? And who are the clients that we look for to refinance into this longer term rental loan? Because for a various amount of reasons, you can find a client who is not qualifiable for a bank. And it could be due to credit. It could be due to not showing enough income, as small business owners typically don't like to show that much income, right? It can be because maybe the property is dilapidated. But it can also be because you have an A-plus client with 20 properties and 10 conventional loans, right? The unicorn. Maybe the banks aren't extending them more leverage. So what kind of loan are they sitting in right now? They're sitting in a private loan or a hard money loan, interest only. They're sitting in a portfolio loan, maybe an adjustable rate mortgage, maybe a 30-year loan with a 5/1 ARM, something like that. This particular loan that we were able to put together is for that client specifically because I haven't seen a fixed rate loan for a 30-year term on the rental property with the minimal underwriting that is required by this particular loan that we were able to put together. So with that being said, you've heard about this loan here, and take a look at that flyer. You've probably seen it on our social media feed. We are very excited to roll it out. For this particular client, we did write the loan at 6.99%, fixed rate, 30 years. We didn't look at any financials. We didn't look at any bank statements. The client's FICO had to be 650, and we had to have executed leases. And outside of that, as long as the property appraised, we were golden. And so we wanted to wait until we were able to close that deal out, kind of go through the process before we put together this deal profile video, because it's very important for us to be able to come through on our word. So with that being said, appreciate you sitting through that intro there. We're going to jump into a few slides here as well. If you take a look at this video, everything is confusing, you want to go over in more detail, please give me a call. I will be happy to share these slides with you and kind of go through it in more detail than we're going through now. But at the same point in time, I wanted to get into a lot of detail so you understand what we're looking for. So you, or if you're a mortgage broker out there, your clients, you know how to talk to your clients about getting approved for this loan. It's an outstanding loan. We're very excited about it. It'll especially work for clients in Tennessee, Missouri, Texas, Florida. Those are all markets that we're about to penetrate here on our side of things to be able to offer. So if you're in those markets and interested in this loan, feel free to reach out and let us know. So with that being said, let me pull up the first slide so that we can chat about this particular deal. So on this particular deal, our client had an outstanding mortgage of about $391,000. The interest rate that he was currently paying on this particular loan was a 9.25% rate. Now that was an adjustable rate mortgage. So originally he had this loan a little over 3 years ago, and the initial rate offered was in the low sevens. I think it was like 7.25. But it has adjusted over the last 3 years, 3+ years, to 9.25, and it's safe to say that it was continue to adjust, right? So with that particular interest rate right now, the current payment that he was looking at was about $3,245 and change. Now that didn't take into account his taxes and insurance impound, and I put that there because we will talk about that a little bit later as well. So the client and I have known each other for quite a while, and we both wanted to get this loan put together for him. So we went out and shot for a $415,000 loan. I talk to clients all the time on refinances about shooting for a higher loan amount and being able to come down. So as you can see, the discrepancy between 391 and 415, it's pretty large. Worst case scenario, we can always come down in loan amount if the client is looking for just a strict rate and term. So we shot for 415 on the front end. We were able to hit that. And the rate that we were able to provide to our client was 6.99%, and that is a fixed rate. No adjust, fully amortized, 30 years, fixed rate. The new payment amount that we were able to get to put together for the client was just under $2,760 a month. So just on face value, if you stop this video right now, you'll see that there's definitely some significant savings, but it's important for us to figure out how we get into that particular number. We're going to take a look at the next slide, which is ideally named Dive into the Numbers. As we look into these numbers, what we'll see is that the property value is about $805,000. That was an appraised value. So our loan amount of $415,000 only comes in at about 51.55% loan to value. Very conservative loan to value. Any private lender, any lender usually in general will be happy about that, and we were very excited to put this one together for that. Then the next step is to look at property debt to income ratio. We'll explain that in more detail on the next slide, but basically we're going to look at the monthly mortgage payment, principal and interest, your tax impounds, which you'll see the calculations here, but we'll pull them up later, and your insurance impounds. And I did those backwards, but that's okay. We'll take a look at these a little bit later. You can see the calculations there. With this particular loan, we're very, very interested in the PVTI, which stands for Property Debt to Income Ratio. What does that entail? That entails 4 major expenses for the property that we look at. You have your mortgage payment, principal and interest. You have your tax impound account. You have your insurance impound number. And lastly, if it's a situation where the property requires some HOA fees, we want to lump that in as well. You take the total of all of those costs, so just 3 to 4 particular figures that you're going to total up, and you divide that number by the gross rents. The beauty about this loan, we do not, I repeat, we do not need rental seasoning. That is a huge thing for us. If you have an executed lease of today, we can utilize those gross rents into our calculations. If the property is currently with month-to-month leases, all we have to do is confirm that those tenants have been in place for the last 6 months, and we should be able to use those particular rents. So it's a very flexible underwriting situation when you're talking about not having to have rental seasoning and really only taking into account these 3 to 4 expenses. So now that we know what PVTI is and how we can get there, let's look at this live deal that we're looking at and kind of calculate the numbers to get the PVTI for this particular property. So let me pull up that slide and we can go through that. As you can see, the mortgage payment, principal and interest, is $2,758.22. Insurance impound, $93.92. Tax impound, $433.33. And we calculated those impounds from a previous slide. The total expenses of the actual property on a monthly basis, $3,285.47. Now we take that number, divide it by 5,000, and you get to a 65.71% PVTI calculation for this particular property. The beauty about this is we can go all the way up to 89.99% PVTI calculation for any given property in order to approve for this loan. If you are between 80% PVTI and 89.99%, you're going to get a slight interest rate hike. If you're below that 80% number, which we are here, it's going to be more favorable for you. If you're even lower, like in the 50s, there's going to be a rate rebate for you. Probably not going to come up, but in case it does, we can definitely take a look at that. We're going to roll that slide into the next one so we can compare apples to apples on the previous loan that the client had that we paid off and our new S&L Capital Group loan to kind of show you the overall savings that we were able to put together, which is pretty jaw-dropping if you ask me. Again, we have a loan of $391 for the previous loan, a 9.25 adjustable rate mortgage interest rate, There's the payment and the taxes and insurance. We get a total monthly obligation of $3,772.38. On our loan, the stats haven't changed. $415,000 loan amount, 6.99% fixed. There's our payment. Add in taxes and insurance impound, and you get to a total obligation of $3,285.47. This is a saving of $486.91 per month. Quickly, and when I say quickly, over the next 12 to 24 months, the client is going to recuperate the cost for the refinance, which is a huge win. They're going to lower their monthly payment. They're going to pay down principal. They're going to be stuck in a fixed rate loan for 30 years. They're not going to have any adjustable rates. There's not going to be any movement. They can plan their cash flow out. If the client happens to stay in this loan for 30 years, which is highly unlikely, without selling the property or without refinancing, based on the trends of how many refinances people do on particular properties, every 5 years or so, we're going to save them $175,000. That's against a 9.25% rate. Adjustable rates typically adjust up often and frequently, so it's probably going to be more than that. So we're excited about this loan. This loan to me is something perfect for that investor for whatever reason cannot conventionally qualify for a loan. And we know that clients sometimes can't qualify for conventional loans for a multitude of reasons. It can be simply because of credit issues. It can be because maybe they don't report as much income as they should to take on another property or another conventional loan. And as we mentioned before, it can be the best borrower profile that you have in the world, but they simply have too many conventional loans, and now banks are pulling back a little bit. We hear it all the time. So I am really excited about this program. It's a great rental program for seasoned professionals who are real estate investors, who want something long-term, who don't necessarily want to go through as many hoops as they need to get conventional. Now, rates for conventional are historically low. We know that. If you can get the conventional loan approved for your client, or if you are the client, go get the conventional rate. We're telling you that right now. But for those of us and for those of you who are looking for an alternative option for a long-term rental program that doesn't quite need all of the red tape or all of the underwriting requirements and timelines, give us a call. We can definitely put this loan together for you if it meets the criteria that we need to. So with that being said, I'm going to throw a slide up that shows you what we need to get you pre-approved. And what I mean by that is we can go through the numbers on the front end, and then we can look at these particular items to get you a solid idea of what we're going to do. Then it's all about the process. And we've ironed out the details of that process. The borrower needs list. We want an application that I can provide to you. We would like to see lease agreements because we need to have them executed as of today, or if they've been in place for a while. Business entity documents, if you're holding title in an LLC or corporation, your annual insurance premium. You send us the declaration page for your insurance. You send us your evidence of insurance, however we can get to that. And then a paid tax bill. I mean, we can pull that up off of public record in most cases, but at the same point in time, if you send that to us, it really helps us kind of expedite the process. And those are the 5 things. From there, we can issue you disclosures. We can go through the process very smoothly, order the appraisal, and it's more about a formality at that point in time. With that being said, that is it. I mean, that is the deal that we are excited about. This loan structure, I think, fills a great void. If you are a mortgage broker, if you are a private lender who specializes in fix and flip, please give us a call. We would love to fill some holes for you if there is a need for a refinance rental program on some of the projects that your clients are renovating to hold as rentals. We love when we get paid off on our short-term loans. I'm positive that your investors do as well. So we can take this rehab project and convert it to a rental loan by doing a quick refinance. The client can pull out some cash and they can get back on to doing more fix and flips. So again, Brad and I are very excited. We've been working our butts off to get this available. We're getting ready to roll this out in Tennessee, Texas, Florida, and Missouri. All of those areas we know pencil out from a cash flow standpoint. So if anybody you know, any real estate agents, mortgage brokers in those neck of the woods, have any clients that are looking for a 1 to 4 unit rental program, fixed rate, very easy to work with, please keep us in mind. My contact information will be listed here at the end of the slide. I appreciate you hanging in there for a pretty extended video. I hope you found it useful. We're going to try and do a couple deal profile slides and videos moving forward on some of the other stuff that we do as well. But we're very excited about this program. We think it's a very good option for us in the market, and we're excited to keep rolling it out. So thank you so much. Again, thank you so much for the support. Let me know if you have any questions, and I look forward to hearing from you guys soon.